to Larbi Premium Consult. On this channel, we share educational content ranging from mathematics to accounting.
Yeah, so welcome back once again to our live session today. So as we discussed or we communicated, today's live session is going to be a Q&A practice exams question on promissory notes. And later, if you have any other question concerning business math, you can drop it in the comment section whilst we take the discussion further. I hope I can be heard loud and clear. If you can't hear me, let me know in the comment section. I hope I can be heard loud and clear so that we get started. I hope I can be heard loud and clear. I want to confirm that before we start the discussion going. If I can hear loud and clear, let me know so that I can start. In the comment section, let me know. Please do also like the video and share it as well in that case. Oh, each and everyone can hear me. Okay, that's fine. Then let's get. So the following questions are what we're going to look at based on our previous lessons on simple interest, compound interest, and then promissory notes. So in our past video, we just look at simple interest and compound interest together. So in today's session, we are going to look at a promissory note, question on promissory note, and then going forward, if you have any question, you can let me know so that we take the discussion going in that case. So it goes like, on July 25th, Lali Company borrows $100,000 from Anti-Ajara Investment Company. In return, Lali gives a company 180 promissory notes at exact simple interest. So you have exact simple interest of rate of 12%. Anti-Ajara Investment Company could not wait for the note to mature and then decide to discount the note by transferring the note to a Mayweather Financial Service on October 10 at a discount rate of 15% of the maturity value. You have to use this information to answer question 11 to 19. Remember, what we started the last time was from 1 to 10. So we just have to know that there is a continuation of it in that line. So let's take note of that. I hope I can be heard loud and clear, please. Because we want to achieve efficiency here so that we know that each and everyone is at. Okay, so our first question next. What is the due date? What is the due date? What is the due date for this transaction? So here in this case, this is what we need to know. This is what we need to know. Who is actually the debtor of this promissory note? Here is a promissory note, right? Because there's an issue about 180 promissory note here. So who is the debtor of this note? That is from what? Lali Company. Okay. And then the payee of this note is what? Anti-Ajara Investment what? Company. right? And then the third party is what? Mayweather Finance, what? Financial Service, right? Okay. So if that is what we have, then that's fine. So we are asked to calculate what is the due date. What will be the due date? The due date is actually the date when the transaction actually occurred, together with the number of days that was given to actually settle off what the debt in that line. Okay, settle off the debt in that line. So this is what we're going to do. For us to get the due date should be equal to. So we say that due date in this case should be equal to, on what date is the transaction? Okay, that was July 25th, right? So we have what? 25th of July. So we have 25th of July plus what? So what was the number of days that was given as a promissory note? That was 180 days. So we have what? 180 days. So once you get the 180 days, you just add the two. Please, I hope I can be heard loud and clear. No one is trying to respond to this in the comment section. So here we just have to play with what the numbers, okay? So we will add 25 plus what? 180, okay? So what is 25 plus 180? I think that is 102, okay? That is 102. That is 102. I said 102, 205 rather. So you're going to get 205. So you get 205 days. 205 days. Okay. So once you get 205 days, here, since we are talking about exact simple interest, then we are making use of what? Our normal days in the month. So how many days do you have in July? How many days do you have in July? That is what? 31 days. So we started the whole approach by saying that, okay, if that is so, then we can say that 205 minus, so July is what? 31. So we take 31 from here, okay, and then from July move on to what? August. So August also 31, then September 30, October is what? October is what? October is 31, November is 30, then December is what? 31. So you are left with what? 21, which is a normal day in a month. So that should go into what? 21st of what? That's 21st of what? January. Because from December, we move on to what? January. So our due date then is going to be on what? 21st of what? January. 21st of what? January. So let's take note of that. Let's take note of that.
Welcome back to Larbi Premium Consult. On this channel, we share educational content ranging from mathematics to accounting. Welcome back to Larbi Premium Consult. On this channel, we share educational content ranging from mathematics to accounting. Welcome back to Larbi Premium Consult. On this channel, we share educational content.
So let's continue actually. There was some network connectivity and technical faults, so I need to correct that. So let's take it from here. We were talking about the due date. Please do all to share the video so that others who were online can join us, and then so we continue in that line. So we're talking about the due date. What is the due date for which we know is 25th of what? July plus what? 180 days. And when we add the two, we're getting what? 200 and what? 05 what? Days. Please, I hope you can hear me now correctly. You can hear me loud and clear. Okay, so if that is the case, we're getting 205. So we said that we just make use of what the number of days in the month, because we are talking about exact what? Simple interest. We know that the transaction occurred in July. So we're getting what? 205. So July, you have 31 days. So we subtract 30. We first subtract what? The first 31. And then we move on to subtract from July, move on to what? August, which is also 31. Then September, which is what? 30. Then from September, we move on to what? October, which is 31. Then November, which is what? 30. And December, which is 31. So when we subtract all, we're getting 21 days, which is also a normal days within what? A month. So we can say that our due date is going to be on 21st of what? July. 21st of what? July. So let's take note of that. So let's continue. So you're asked to find what is the maturity value of the promissory note. So how do you calculate the maturity value? To calculate maturity value, MV is equal to what? So here we want to know the maturity value of the loan, which should be equal to what? The initial loan, which is what? The principal plus what? The interest. In this case, there's that simple interest, right? So before we can get the simple interest, or before we can get the maturity value, you must calculate what the simple interest in that line. Okay, so let me bring that here. So I can say that my xi should be equal to what? My principal multiplying my rate multiplying what? My time. In this case, I'm going to the number of days in question here. So I know the principal in this case was what? $100,000. So we have what? 100,000. Okay, you have 100,000 multiplying what? What was the rate for this 180-day promissory note? That was 12%. We can see that here. So 12%. And then multiply by 180 divided by, since we are talking about exact simple interest, we are making use of what? 365 days, which is a normal number of days in a what? In a month. So in a year. So let's take note of that. So we have what? 180 divided by what? 365. Please share the video so that others will join us in that class. And you haven't liked, to do all to like the video as well. Okay, so here when you take your calculator to calculate this, with my case, this is what I was getting as my simple interest. I was getting what? Or I had 5,000. I have 5,917.81 in two decimal place, 0.81. Okay, so once you get the interest, that's fine. The next thing you're asked to is to find the maturity. So what will be the maturity value then? Maturity value is going to be the principal, for which you know is what? $100,000. Okay, plus the interest of what? 5,917 point what? 81. Okay, so what are we getting at the end of the day? When we add the two, you're supposed to get what? 105,917.81. So this is going to be your maturity value in this particular what case. Okay, so once you get a maturity, that's fine. The next question here is you're asked to calculate what is the discount amount lost by Anti-Agile Company Limited because they could not wait for the maturity date. So here, if you are talking about the discount lost by Anti-Agile, that's going to be the interest that the third party, which is what the Mayweather, will earn as an interest because Anti-Agile couldn't wait as part of the information. You couldn't wait and then discount the note on the said date. That was what? What was the date? That was on what? 10th of what? October. October 10. You couldn't wait and then discount the notes at the rate of what? 15%. So you're going to lose 15%. That's what you're going to lose from the maturity what? Value. So here you want to know the discount what? Amount. Okay. So you say that discount amount is equal to what? You know discount amount is calculated as what? The maturity value. Because even the question even said that of the rate of 15% on the maturity what value. So this is the discount that is going to be lost on the maturity value by what Anti-Agile Company. So it's going to be the maturity value multiplying what the number of days from the time was discounted to the due date, then multiplying what the discount rate. Remember, multiplication are commutative. So let's take note of that. Okay, so now let's see. We know that the due date is for 21st of July, and then the discount of this maturity value occurred on what? 15th of what? Sorry, 10th of what? October. So how many days do you have from 10th of October to 21st of what, July? This is what we need to know so that we can easily get the number of days for the T, the time factor. So here we'll say that 10th of what? October to 21st of what? January. How many days do you have in here? So here, since we are using our normal days in the month, October has what 31 days, right? So means that 10 is already gone. So if you are talking about 10 here, then we take 10 from 31, we are left with what 21, right? Okay, so from October, you move on to what November, which is 30, you add it to it. Then from November, move on to what December, which is what 31. Then you come to 21, that will end up to the due date, okay, for January. So when you add, or let's see what you're going to get 21 plus 30 plus 31 plus 21. You are going to get what 103. That's what I was getting in that particular case 103. Okay, so once you get a 103, therefore you tell us that our discount amount should be the maturity value of what 105,917.81 3 divided by 365. Since you are talking about exact simple interest, just divide by 365, and then the rate of what? The discount rate was what? 15%. So we have 15% here, 15% in that particular case. Okay, so when you calculate this, with my case, I had my discount amount, that's the amount lost by Anti-Agile, to be equal to what? 4,483.37 into the decimal place. I was getting 37 in that particular case. So let's take note of that. So this is also how we calculate discount amount. You just multiply, you just have to find the number of days left, or depends on the period from when it was discounted, the maturity value was discounted to the due date for the maturity value, so that you get to know the time period, and then use that to multiply the maturity value together with the discount rate, and you get your discount amount. So this is the amount that's going to be lost by Anti-Agile, and this is the amount that Mayweather will receive for the rest of what taking up the third party, the amount the data, the amount the data is supposed to pay. Now Mayweather is the one who's going to assume the risk, and the risk is that the data might not pay the exact amount at the due date. So that is the risk factor here. So let's take note of that. Question 14. How much did Mayweather Financial Service pay to Anti-Agile as interest? So how much did they pay to Anti-Agile as what? Interest. So you know that the total interest that Anti-Agile should have received as full interest if they should have waited for the loan to mature was what? In this case, we calculated that we're getting what? 5,917.81. Okay. But since they couldn't wait, and this is what the Mayweather or the third party is what receiving as an interest, when we subtract this amount from this total amount of interest, whatever is going to be left going to what going to pay towards anti-Ajara as an interest. That is how it goes. So here you say that interest to be paid to anti-Ajara, interest to be paid should be equal to the initial total interest. Okay, that's the initial total interest or the initial interest. Okay, minus what? The discount amount, which is the interest for the third party. So what are we getting? So we have here to be 5,917.81. Am I correct? Yeah, 81 minus what? Minus 4,483 point what? 37. When you extract, you should be able to get an interest amount of 1,434.44. Okay, you get this as your interest what amount. Or better still, all that you can also do is that you can subtract the interest that Mayweather or the third party is earning from the maturity value. Whatever you get, okay, whatever you get, whatever you get at the end of the day, that becomes the process going to pay to anti-Ajara or the payee. So when the payee compare that amount together with the initial loan, which was what 100,000, whatever going to be left is going to be the same thing as what 1,434.44. These are the two ways you can calculate your interest, right? That the payee will receive, right? So let's take note of that. Let's take note of that. Okay, so once you have gotten that, then we are good to go. Then question 15 says that how much does Mayweather Financial Service make from the transaction? So how much does it make from the transaction? That is what the interest that they will earn as a discount amount of what? 4,483 points what? 37, right? Because the transaction was discounted on what? On October 10. So from October 10 to the due date for which we were getting what? 21st of January. From that time to 21st of January, the number of days involved is the risk that they're going to take from the data of the note, right? So when we calculate the number of days, that's where we calculate the number of days and we're able to get towards 103 from October 10 to 21st of what? 21st of January, it was what? 103. Okay. So use that together with divided by 365 days, multiply by the discount rate from the Mayweather Financial Service, and then multiply by the maturity value because it says 15% on the maturity what? Value. So that's why we're multiplying on the maturity what? Value. So let's take note. Okay. So here, this is what they was earning. Mayweather will actually earn. How much does Mayweather earn from the transaction? And that should be what? The amount of what? So in reference to number question number 14. I said question number 14. That's question number 13. Mayweather will earn an interest of 4,483.37. So that's what we're going to earn at the end of the day. Right. So let's take note of that. Okay. Question number 15. What will have been the maturity value of the loan if the amount borrowed was what? $120,000. What will have been the maturity? So here the examiner wants you to actually want to play, with the variables in the calculation of the maturity value and then other issues. We know that we were given 100,000 as the initial transaction, right? That took place between Antiajara and the Lali company. But here lies the case. They are trying to tell us that let's assume that the loan that was borrowed was what? $120,000. what will have been the maturity value. So yeah, the only thing that's changing here is what? Just the loan. So all that information will be used to calculate that, with the exception of what? The initial 100,000 that was given. So here we'll say that the before we can get a maturity value for this 120,000 as a loan, then we need to have in mind the interest factor, for which we know our simple interest in this case should be equal to the principal, which should be what? As a loan of what? 120,000 rate of what? The rate of 12%, and then multiplying what? The time, which is what? 180 divided by what? 365. Right? Okay. So once you're able to get this, then with the help of your calculator, let's see what you're going to get. You should be able to get. So in my case, I had what? 7,101.37 in that line. You can confirm that and let's see if that's true. So this is what you're going to get, assuming the amount that was borrowed by Lalik from Auntie Ajara was what? $120,000 in that particular case. So let's take note of that. Okay. So this is going to be the interest, assuming that was so. Okay. The question 17 is saying that how much interest would Auntie Ajara company earn if they discounted the 120,000 loan, this discounted 120,000 loan using the same discount rate and then on the same day as before. So how would have been the interest in that particular case? So here, instead of the 100,000 that was given that we were discounting, here lies the case now. The examiner is assumed, let's assume that we were giving just what? 120. We're giving just what? 120 $120,000 $120,000 as the loan, right? And this was the actually the what was question 16? Okay, I think question 16, I need to add other information. I'll come back to it. We were giving 120 loan the same day. So what would have been the interest that would how much interest would anti-agile company earn? So let's see. But before that, I think question 16, we are not done. The examiner asked us to calculate what will have been the maturity value of this amount. So here, this is just the interest. So for us to get the maturity value, we'll therefore say that the maturity value, before we come to, I thought we were just talking about the interest alone. So the maturity value should be equal to the principal, in this particular case, the 120,000, okay, plus the interest that was given to us as what? That we work and we're getting what? We're getting 7,101.37. So in this case, you'll be able to get 7. So that's what we need to know. So question 17 saying that how much interest would Auntie Ajara earn if they discounted the 120 loan, the same discount rate, and on the same month day, right? So now there's a maturity value, and they are saying that using the previous word information that was given, assuming that this was what it was given, and we discount this on 10th of what? October, what will have been the interest that Auntie Ajara will earn? For which we know we should calculate our discount towards amount using the third party rate, right? So what will be the interest that the third party will earn in this particular case? So here you're going to use the same what number of days, so from 10th of October to what 21st of what January, right? So that's going to be what 127 as a maturity value, assuming it was what 120,000, for which you get maturity value of what 127,101.37, multiplying what the time, which is what 103 divided by 365. Here, the condition is that is only the loan or the principal that is changing, the rest remains the same. That's why you don't see anything changing. You only just the loan and then the maturity value, just a change in variable, right? And then multiply by the discount rate from the investment. That's the Mayweather company, the third party, which is what 15%. So once you do this, what are you getting? I had my discount rate to what 5,380.04 into decimal place. Okay, so once you're able to get this, then for us to know the interest that Auntie Ajara will earn, that's going to be the difference between the discount amount, that is what the third party is receiving, from the total interest. That's what anti-agile are going to receive at the end of the day. Or better still, you take this discount amount from this maturity value, whatever is going to be left going to be the process that you're going to pay to anti-agile. Okay. And then when anti-agile compare the process with the 120 value that was given to us, assuming that was the initial value that was borrowed, whatever is going to be left was going to be what? An interest for anti-agile. Or better still, just take the difference between the discount amount and the total interest that Anti-Ajara would have received if he should have waited for the loan to what matured. Okay, so you tell us that the interest factor should be equal to what? The total interest, which is 101, right? 101.37 minus 5,380, 380 point what? 04. Okay, so when you do that, you should be able to get an interest amount of what 1,721 point what 33, and this is what anti-agile will earn, assuming the amount borrowed was 120,000, which was discounted with a maturity value of what 127,101.37. All right. If you have any question, please drop in the comment section. When we are done, I'll just go through all your questions and then I'll explain things for you better. So let's take it. Then question number 18. If Antajara has decided to discount the 120 promissory note, so now the only change here is the 120 that bring on board. Discount the $120,000 promissory note on November 10. How much interest will the company make? So here we are using the 120 as being the change in the initial loan that was borrowed. That is on assumption. And then also the examiner wants us to also to cause a change in the discount what the discount period, because initially the 120 the 100,000 actually no loan was discounted on what on 10th of October. But here lies the case. He said we should assume that we are discounting the change, which is what $120,000 on November what 10. What will be the interest? How much interest will the company make? That is the anti-Ajara company, right? So how do you do that? So here, all I want to do is for us also to calculate the number of days from 10th of November to what 21st of what January. That's the due date, so that we know the number of days involved. We use that to calculate on the maturity value of what 120, and then we get the discount amount for the third party, and when we take that from the total full amount, we get the interest for the company. Okay, so this is what we're going to do. Number of days that we're going to use to calculate the discount amount should be equal to from 10th November to what 21st January. And remember here we are using the normal number of days in a month. Okay, so here we know that November has 30 days in a month. So since we have 10, it means that we were left with what 20. Okay, so from November we move on to what December, which is 31. Then after December we move on to what January. So here the due date ends on 21st, so that's going to be what 21 days in addition. So when we add, or what are we getting? Here is going to give me 41. So we're going to get what are we getting? Let's see. So 20 plus 31 plus 21. You should be able to get 72, right? So the number of days here is going to be 72. So at first it was 10th October here, but here the examiner is telling us that we should make use of what? Assuming it was discounted on what? 10th of what? November. What will be the interest? So here, once you get that, then you tell us the discount amount. Okay, the discount amount in this particular case should be equal to the maturity value of what? Of the $120 promissory note, which is what? The 127,103.37. So you have what? 127,101.37, right? Multiplying what? 72 divided by 365, and then multiplying with the same rate of what? 15%. Rate hasn't changed, which remains the same. So what are we getting? With my case, I had what? A discount amount of what? 3,700 and what? 60.81. So once you're able to get this, that's fine. So the next thing I want to know, the interest that anti-agile is going to earn would be the comparison of this, right? That's going to be the comparison of what? This to that of what? The full interest amount of what? 7,101.37. Okay. Because that was the interest that we were getting, assuming the loan that was borrowed was 120,000. Okay, so the interest that the company as the anti will earn is going to be the difference between this and what? And this. Okay, so interest earned should be equal to 7,101.37 minus 3,760.81. Okay, and what are we getting? With my case, I had what? An interest of what? 3,340.56. You can confirm that and let's see if that's true. Okay, so once you get that, that's fine. That's how you get the interest. Assume there's a change in the discount date. If there is any change in any of the variables, just use that change to work with the other additional information that it has been given, and then you will be good to go in that particular case. If you have any question, please drop it in the comment section. When we are done, I'll go through and then for you to get it clearer in that particular case. Now, question 19. Said a discount rate have to pay anti-ajara if the amount remained at what? 100,000 and the discount date remain on 10th October. So yeah, the change is orchestrated by just what? The rate. If Mayweather Financial Services accepted a discount rate instead of 15%, now that's increased to what? 18%. Okay, but other information that was given from here remains the same. It's only the change of the discount period, which was 15%, but now the examiner is saying that assuming that it was 18%, right, in that particular case, how much interest would they have to pay to Anti-Ajara company if the amount remained at 100,000 and then the discount date remain on the 10th of January? So here, the only thing changing is for the rate, just the rate. So we need to calculate a new discount amount so that we compare that to the initial value or the initial discount, initial interest that Antaja will have received in full if they should have waited for the loan to mature. So we'll say that the discount amount should be equal to, so here we are going back to the original question maturity value, which was what? 105,917.81. Is 105,917.81. Okay, so we just take the difference, we just work out our discount amount using this maturity what value. So this is what we're going to do. We say that here is what? 105.7, was it 917 or 791? Let me see. Yeah, 917. Okay, multiplying or to number of days that was involved was what? 103. From October 10 to 21st of January was 103, if you could remember. And then multiply by the rate. In this case, instead of 15% now, you have set it to what? 18%. So what will be the new discount amount here? With my case, I had what? 5,000. I had 380.04. So this is what I was getting. So once you're able to get this, then for us to know the interest that Anti-Ajara will receive or the financial service will pay to Anti-Ajara, then that's going to be the difference between the full interest, which is what in this particular the old interest that we work when we were dealing with what the 12% interest, and that was what 5,917.81. That's what we're going to use compare that to this initial value. So that's going to what 5,917.81, okay, minus 5,380.04. So with my case, I had an interest amount of what 537 as the interest that you can see that you take the maturity value, which is what 105,917 point. Okay, 917. I think we're having some decimals here. I didn't bring it up. Okay, but still the answer remained the same. 0.81. Then subtract the proceeds of what 5,380.04. You are going to get this, okay, as the proceeds are going to pay to Anti-Ajara. So when we compare this to that of the initial amount that was given or that was borrowed, which was what 100,000, you should be able to get an interest of what 537.77 in that particular case, as you see on the calculator. So this was another way to calculate the interest that the payee will receive from the transaction. Either you take the difference between the full initial interest amount compared to the discount amount, or that's one way, or better still, take the discount amount from the full maturity value. Okay, whatever is going to be less going to be the proceeds going to pay to the payee. When the payee compare that proceed together with the initial amount borrowed, the difference is going to be the amount they're going to earn from the transaction by the payee. So let's take note of that. And that is some few part discussion on promissory notes in that particular case. So if you have any question on this, let us know. Any question on this, be welcomed. Let us know. If you have any question, I think I saw one question here. Prince a champion junior is saying that, please, I don't understand question 13. Please, can you go over? I think I explained that when we were solving question 14 or so. So I don't know whether you're okay with that. Prince, if you're online, let me see if you're okay with question 13. Let me see in the comments. If you're okay with it, then that's fine. So let me see in the comment section if you're okay with that, and then we'll take it from there. If you're not to, drop a comment in the comment section and let's see. Any question? That is all for a promissory note. We are so sorry for what happened, the technical challenge that we're having here. So it was just some technical challenge. I need to correct that before we can have a smooth discussion. All right. So we are so sorry for that. We are hoping that in future it won't happen again. So do all to like the video, subscribe to the channel, then share. So I'll end here and see you next time. Any future question can be dropped in the comment section and I'll come back to answer you in that particular case. So thank you and have a nice day. Bye.